Hi guys, and welcome to this TA session on trading strategies. In this session, I'm going to explain what trading strategies are, what kind of strategies there are, and how to develop them. I'm going to show you some examples on strategies and what it means to maintain a strategy, and as well how to adapt or change strategies based on changing market circumstances. This will probably become a deep dive session because I can't cover all this stuff in like 10 to 15 minutes, but I think this will be okay. A lot of you signaled that you want to know more about strategies and how to build them from scratch. And this is what we're going to do, because I think this is a very important topic and it is insufficiently covered in trading courses and on the free stuff you find on social media, for example. There's a lot to trading strategies that most influencers and trading courses won't tell you, simply because it doesn't resonate with beginners too much. It can become quite complex. This topic is not, shouldn't be underestimated in terms of complexity and effort you have to put in. But let's approach this from a very simple point of view, and then we are going deeper into it. And if you have questions, feel free to write them down in the comments, join our Discord, discuss with us. What kind of strategies are you using? What are your experiences with this kind of approach to trading? And yeah, I would be happy to talk with you about that. So let's start. The first thing we have to look at when we talk about strategies is the definition of a strategy. So what is a trading strategy? In contrast to strategies in warfare, for example, trading strategies are a little different. They actually, most of them operate on simple logic. So you have very, very simple logic that is reduced in complexity to formulate some kind of action plan that helps you in order to identify certain situations in the market, in price action, that you can act on, that you should act on because the strategy tells you so. So, for example, let's take a very, very simple example. Whenever we see three green, or in this case blue candles in a row, we want to buy. Well, let's look at where this condition that we just set, where this condition is met. So where are three buying or blue-green candles in a row? We have this one, this. So we would actually buy after this candle has closed. This would be our condition that is met, and our action bound to the strategy is we would enter the market with a long, or we would buy at this point when this candle is confirmed. Then we would also buy this candle. We would also buy this candle once it is closed, of course. We would also buy this candle. We would buy this candle. Yeah, this is it. So here you can see how simple logic can be applied to make you act in a certain way. So you set a condition. In this case, we set the condition that we want to see three buying candles in a row, and then we enter the market. So you have condition and action. Condition, then you have some kind of checking mechanism that checks on your condition if it's true. This would be you yourself, or in terms in the context of a trading bot, it would be an algorithm checking the conditions. Then it is true. Or if it is true, a certain action is applied, or it is taken in this case. So in this case, this would be condition, three buying candles in a row. And then we would want to enter the market. So enter market, buy. This is a very simple representation of a trading strategy. But in contrast to military warfare, for example, These kind of strategies are very, very, yeah, they are reduced to the minimum of complexity, and they are not adaptable. So in this case, for example, you always have the same condition, and the mechanism, either you yourself or the trading bot or whatever, is checking on this condition and acting on the market and acting, it's actually enter or exiting trades based on this condition only. But of course, strategy implies that there is some kind of adapting taking place. So what we want to see with a good strategy is that it is adapting, that it is being changed on the fly to what your opponent, for example, does. And who is your opponent in this case? In the markets, you don't really have an opponent. You have players that are also involved in the market, participants, however you want to call them, but you don't really have an opponent. So you actually operate on simple rules in this case. But in a military action, for example, you have an enemy or opponents that also react to your strategy and counter this. So you have to adapt in order to counter his or their counter again. So basically, it's an exchange of counter actions until one side actually prevails. And this is something that you don't have in trading. So what we are calling a strategy here is actually not really a strategy, but it is, it's something between tactics and strategy. It is very, very simple and not adaptable. So, but to make up for this, because markets can change as well, your opponents or enemies can change their strategies and approaches. The market can change its conditions and circumstances. So the market actually is changing too. So we do have always to think about how to make our strategy more adaptable and flexible in order to cope with the different situations we might be entering from time to time. So you see where this is going. We want to get rid of this very simple approach of just having a basic condition and then acting on this condition. What we want to do is to have a true trading strategy that is adaptable. However, before we are going into this, I'm going to actually give you an idea of what kind of strategies there are. If you have seen some of my videos already on YouTube, you know that I really like the term static and dynamic. In TA, there's a lot of, there are many elements and mechanics that you can describe as static, unchanging, very simple and straightforward. And there are mechanics, tools, elements that you can describe as dynamic. They are adaptable, changing, flexible, and they are more difficult to handle, but they are more powerful because they can adapt to changing circumstances. And I want to apply the same logic to strategies as well. So according to my personal definition, I define strategies as static strategies. One type is static strategies. Then we have semi-dynamic strategies. So basically, we have strategies that are in between the static state and the dynamic state. There's some kind of trade-off happening here between complexity, usability, and adaptability. So then the third type is the dynamic strategies. These are the three types of strategies that I want to talk about. And I want to give you examples for all three of them and how to build them. You have to find the way that is resonating with you most or best. Dynamic strategies are more complex than static strategies, but static strategies are more simple. Dynamic strategies are more complex, static strategies are simpler, but dynamic strategies are adapting themselves to market circumstances. Static strategies are not. They remain the same forever. So there is the risk of them stopping to there's a risk that static strategies simply stop producing the desired results. This is something that we have to be very careful of, and this is why a lot of people still lose money despite knowing that or knowing how to formulate and develop a strategy, they still lose money. Even if you are emotionally self-controlled and you can act on your strategy like the conditions and rules tell you to, it's not set in stone that you will be successful with this approach, because strategies are things that also have to be changed with the market. And many traders are simply not capable of doing so. They don't have the skills to change a strategy. Maybe they have copied the logic from an influencer or professional trader on the internet somewhere. They have seen a cool strategy, moving average cross on a stream, for example, and they're copying the strategy. And at some point it stops working. It's not effective anymore. And it might even lead to you losing money. And this is something that people don't really understand, because they think a strategy is adaptable in itself, but it is not necessarily. So you have to take care of that. Let me summarize this really quick. I'm going to write down some notes here. Static strategies remain the same. They are easy to handle, simple logic, and they are not adaptable and might stop producing the desired results at some point. So this is what static strategies are. Okay, doing it like this. And then you have the semi-dynamic strategies. And these strategies are actually some kind of trade-off. They are easy to handle, but on the other side, they are, maybe a little bit more dynamic than these are. But let me talk about dynamic strategies first, so we know exactly what we're talking about when we're talking about the trade-off here. So dynamic strategies are strategies that are changing themselves, and this can be achieved through two different methods. Either you you're using, let me simplify this a little bit. So this can be achieved by changing themselves through the use of dynamic TA. So if you have seen my Cloudy series, you know what the difference between static and dynamic TA is. Dynamic TA is TA that is actually, it's changing itself based on new market conditions. Everything that is dynamic, a moving average, for example, it's following price. It's representing an average, so it's always changing. A trend line is not changing. It's simple projection based on past price action. So this is a very common example of the differences between static and dynamic TA. And by using dynamic TA to formulate strategies, you have created a dynamic strategy that is changing with the market. And these dynamic strategies are adaptable and could potentially remain effective in all eternity. Of course, it depends on the kind of TA you're using, if it is actually compatible with different markets, for example, bear markets, bull markets, and so on. But in theory, it's possible to make this a strategy that you can use in all eternity. You don't have to touch anymore because it's working. And it will always work because it's dynamic in itself. However, it's more difficult to build, of course. So they are difficult to build and handle. Very important to know. So the semi-dynamic, I'm not sure if I pronounced this correctly, but so the semi-dynamic strategies are in between. They are actually dynamic because they have more logic in them. So basically they are using static TA, but with more logic in example branches that you can define to come up with better actions, signals, actions based on the situation. So I hope this makes sense. You have a strategy that is based, like a static strategy, it's based on, for example, it's based on a moving average cross. The moving average 8 is crossing the moving average 20. This is very simple. And now what you want to do is to implement more logic into this to make it more flexible, more adaptable. So for example, if the single condition is moving average 8 is crossing moving average 20, but you have a second condition. For example, if we are in a downtrend, then you don't take the moving average 8 and 20, you take the moving average 12 and 26. So the strategy is actually changing its parameters and the elements it's using to come up with a signal or to check on the conditions based on the market situation. And this is where you have to put in your knowledge on TA and on the markets, and you have to come up with very useful logic that you can use to improve your strategy so that they become more adaptable. This is a very good way to keep working with very simple approaches, but make them more powerful. And it is also very well suited to use with trading bots because it is programmed in a very easy way. Dynamic strategies are more work. You have to put in more effort to come up with what you're actually doing there and how it is working out. And you have, of course, you have to test this because you can't say from the get-go, you can't really say that it will be effective in all kind of scenarios. Your TA, the dynamic TA you're using here, has to be very reliable. And it's not easy to come up with a TA that is necessary to actually produce these results you're expecting here. So this is why most trading courses and influencers and whatever are teaching you static strategies and very rarely semi-dynamic strategies. This is what you, let me guess here. I think about 90% of the strategy content on social media is about static strategies. And I think about 8% on semi-dynamic strategies. And then we have maybe at most 2% of the content that is based on dynamic, or that is actually talking or teaching you how to use dynamic strategies. So whenever you want to learn something about static strategies, it's very simple. You just go to YouTube and you look up trading strategies, and 9 out of 10 strategies you will find are static strategies. They are very simple, very easy to handle, very easy to replicate. You can simply put 2 lines on the chart, wait for a cross, enter the market, wait for counter cross, exit the market or short or whatever. So there's a lot you can do with these things. You can apply them very fast. You can try them out. You can learn how markets react, how price action is playing out based on these simple strategies. So it's actually a very good approach for new traders. So if you're new to trading, I would recommend to start off by using static strategies and see when they, how they work, how reliable they are, and how long they will remain, how long they remain reliable. This is a very important aspect. Watch when your static strategy falls apart. There will come a point when the strategy ceases to work. It will come. And once this happens, you have to find out why it happened. So you actually learn this way what is changing about the market, what is changing on the charts, in the market, with the sentiment, for example, that prevents this strategy from producing these results it had been producing all the time. So this is a very good way to learn. And when you want to dive deeper into the topic of coming up with very effective strategies, I would recommend you to think about developing your static strategy that you currently have into a semi-dynamic strategy by implementing more logic. If in a bear market we want to short earlier, not super high, and we want to long deeper because we expect bigger retracements or bigger dumps. So this would be a simple condition, circumstances-based or context-based condition that we implement into our strategy. So you can come up with a lot of different conditions and rules that actually make your strategy more powerful, more effective. Of course, you have to test whenever you change something about your strategy. You really have to test: is it working out? Does it really produce the desired results now with this change? If there's a change that doesn't make sense, it is not working, get rid of it. Try something else. So you have to do a lot of trial and error to come up with good semi-dynamic strategies. But if you wanted to dabble in dynamic strategies, you want to find out if this is something that you can use to enhance your trading. And at this point, I would recommend this to everyone who is very, very experienced in TA. So if you have a broad understanding on the markets and the tools you can use to analyze certain situations, and especially you have a good understanding of dynamic TA, that I'm going to talk about in a few minutes, then you can approach this, but you have to keep in mind that there's not much material out there you can take in order to get a good to really get the basics down. You have to develop this from scratch by yourself, because there are not many people who are talking about this even. This is something that is being discussed in the context of artificial intelligence, for example, with an intelligence that is actually adapting to changing circumstances. So this would be a methodologically different approach to creating dynamic strategies. You can use dynamic TA, but you can also use dynamic tools, for example, artificial intelligence. So it actually, it's thinking for you. Of course, not everyone has access to these technologies and can't simply implement AI into their trading strategy. And I guess most of you are trading manually on an exchange and you don't use any trading bots whatsoever. So what you want to do is, if you want to get into dynamic strategies, you have to learn dynamic TA first, and then you can approach this. Okay, this should be an introduction to the different types of strategies that you can look at. Let me get rid of this, and then we continue with the next step. Now I'm going to show you examples for all three kinds of strategies so that you get a feeling for what we are actually talking about here. Okay, let's start with a static strategy. I go to the 15-minute chart on Bitcoin. Here you can see we have this super ugly chop price action, and it actually, this is the reason why lots of people lose money nowadays, these days, because this price action is hardly predictable. It's extremely difficult to trade. It's very nasty for leverage margin traders. So let's see if we can find a static strategy that actually works with this bit of price action. It's not easy to do, but we can try. Okay, so the most common approach to static strategies is using a moving average or exponential moving average cross. This is very, very simple, but it's also working quite well. This is why it is so popular. So let's get the EMA indicator from Tradingview, and I'm going to put on the chart the, let me make this green, for example, here. I want to have the 12, the EMA 12 on the 15-minute, like this, or maybe not 12. This is let me take 26. Then I'm going to copy this, and I'm using a second one, the 52. Maybe not 52. This is, let me get the 76. Okay. Now you have, as you can see, you have two exponential moving averages on your chart. And the approach that is discussed most frequently when talking about strategies is the EMA cross strategy. So basically it means you enter, the first condition is you enter the market when moving average is the smaller moving average. this is the 26, it's the smaller one, is crossing the longer one to the upside. This would be a cross. This here. And this would be the moment when you enter the market. In this case, yeah, it could have worked out. You see, we have an uptrend developing here, and you would want to exit, or you want to short the markets when it's crossing to the downside. The green line, the shorter one, is crossing the yellow one to the downside, which happens here in this case. So you would want to short the market here. You can see we have this kind of retest move here, but then a downtrend unfolding. This is also tradable based on your rules for where you put your stop losses and so on. But as you can see, it's a very simple approach. You would have bought here, but it wouldn't have worked out, as you can see. But you could have shorted here, and then you have this downtrend. Now we didn't have any cross in this in these past 24 hours. And maybe when we see a move up here and this crosses the shorter EMA is crossing the longer EMA here, it would be an entry signal, and an uptrend could be playing out here. This is what a very simple static strategy looks like. It is static because it is not changing. You have fixed rules and you have fixed TA. You have fixed TA. I know that EMAs are dynamic entities, dynamic support and resistance entities, but it doesn't mean it's dynamic TA. A dynamic TA means that it is that the TA itself is changing, not just that the entity is adapting to price action or whatever price is doing, but it means that the entire TA you're using is flexible and adaptable. So this would be a static strategy using dynamic support and resistance entities. However, all of this is static because it remains the same. The logic remains the same. The entities remain the same. All of this remains the same. So it is static. Now, the thing with what I just explained in the previous chapter is that static strategies suffer from changing market circumstances, and it could be the case they stop working, they stop producing results that are satisfactory to you, satisfying to you. So let's see how this particular. Let me take a different static strategy on a higher time frame, maybe the 4-hour chart. And here you can see that we have a cross here. Okay, with some upside, downside price action. We have a cross here, downtrend. We have a cross here, happened here already, so it went down afterwards, so it didn't work out here. As you can see, it's not really reliable. Let's see how this strategy fared here in this sideways price action in 2020. And here you can see we have a cross down, spike down, but it was basically sideways, cross up, move down, cross up, sideways, cross down, a little bit of downside price action here, cross up, upside. Yeah, this would have worked. So as you can see, it's equally unreliable in this part of the in this phase of the market. We had a bullish cross here, a retest move, fail breakout down. So as you can see, it's not a really not a good strategy. And in this bull run here, you can see we had a cross here with buy signal, no signals here. I don't know if this is a sell or not. Looks like it's not. You have a sell here at the bottom, very bad signal. Then we have a cross here after this candle. So here is the sell. It's also a bottom structure. So as you can see, it's not working as good, or if you can even say this like that, it's not working at all in very bullish scenarios. It's working sometimes in bearish scenarios, and it's working sometimes in sideways scenarios. But as you can see, the reliability suffers from sharp uptrends. You would have sold all the bottoms here. So this is something that is very characteristic for static strategies. You have to be careful of that. They don't change. They will remain the same all the time. So the main issue you have here is that yeah, when the market changes, when the market conditions change, your strategy remains the same. It doesn't really consider or account for the changes that are taking place in the market. And this is a huge risk. Your strategy that has been very reliable all the time can suddenly become very unprofitable. And this is something that it's basically the reason why you even want to get rid of static strategies at some point and make them more dynamic. But this is completely up to you. I mean, you have two options here. You can, the first thing you can do is use static strategies like this and change them manually when the market conditions change. So this is the first thing you can do. You use static strategies, but you have to change them manually. So for example, to come up with a new one or to change the parameters by yourself when the conditions change. But this requires you to this requires you to understand, first of all, notice and understand when and what is changing in the market. And to know, this requires you to know how to cope with the changes changes with TA, or by using TA. So this when you want to approach this kind of trading style, you have to, of course, understand what is changing in the market. You have to notice it as fast as possible. For example, right here, this is the spot where you would want to notice that the market is changing. This is the area where the market has started to shift. Look, we had this this super strong uptrend, a first major pullback, still super strong uptrend, and then shortly after this move, this high, we have found our new high and another sharp pullback. So in this case, you can see the market is shifting, it's slowing down, it's becoming more of a consolidation market here, and then you see a new low here, a new low made here. This is a warning sign that we might be entering a downtrend, and this is what you have to notice early to adapt your strategy and to make sure your strategy works with the new market conditions. And you have to know how to trade this based on TA, of course, to actually make a strategy out of it. This is what you have to do in this case. You can also, so besides using static strategies and changing them manually, you can go ahead and, for example, implement additional logic into your existing strategy to cope with the changed conditions, market conditions. So this is similar to the first one. So you're also changing this manually, but it is more of a semi-dynamic approach here. You can turn your static strategy into a partly more dynamic one by implementing new logic based on new data that you acquire along the way. So you see the market is shifting, so you actually implement some conditions that are checking if this market is going more sideways than up, then it would behave differently. So you can upgrade your static, this is an upgrade, you can upgrade your static strategy to a semi-dynamic strategy. This is the second one, second possibility you have in these cases. You can also get rid of your static strategy completely and develop a new one. this is also a very feasible approach. You can, I mean, you can come up with static strategies very easily. So you don't really have to keep them and change the logic or whatever you're doing with the strategy. But rather, what you can do is to get rid of it completely and then develop a completely new strategy, because it's actually very easy to come up with static strategies. You just have to do a lot of testing, what is working well, backtesting stuff, and so on. This is very very important to be to look at the results in the past and what you can expect in the future very carefully, so you can come up with the most effective strategies that match the current market conditions. Yeah. Okay, so this is an example for a static strategy. Now, if we want to make this semi-dynamic strategy, we would check for example, you can do this manually on paper. For example, you have some rules and conditions on paper, or you can use, for example, Pinescript here in Tradingview to develop your strategies and backtest them here with a strategy tester. You can see the performance of your strategy that you have coded in here to see how it fares with the market. Yeah, so I just said that when you want to upgrade your static strategy, you can come up with new conditions like, are we in a downtrend? Question mark. If yes, then we don't take the EMA 76 but the 102. So the parameters are changing along the way. This is something that you can do very easily, and that works quite well in most cases if you have the TA knowledge that is required to come up with the proper changes and adjustments that you have to make. Okay, let me say this. There's an infinite amount of strategies you can come up with. There are no limits. It's actually fairly easy to find profitable strategies. It's not hard. You just have to test, try out various things, and come up with a strategy that yields positive results. This is not difficult to do. However, it is difficult to keep it profitable. Like I just said, the steps you have to take in order to maintain the effectiveness, the effectivity, the steps you have to take in order to adapt to a new market. We're going up, we're going down. Now the things are different. You can make a lot of money here on the way up with your strategy and lose a lot of money here on the downtrend, because the same logic that you're applying here doesn't work anymore and it actually makes you lose money. So you have to react. You have to notice and react. If you can do this, you can come up with very nice strategies, and you can come up with a lot of different approaches on how to trade the markets. And this is really cool. It's actually fun. The second thing that is very important to know about strategies is strategies are only as powerful as your so try to fill in the gap here. Think for yourself. What is it that you have to actually make strategies as powerful as possible? So the thing here is, a strategy is a rule-based system. In trading, a strategy is a rule condition-based system. And the one thing that is disturbing a rule and condition-based system is emotions. So strategies are only as powerful as your ability to act on it. This means that emotions tell you different things. Look, you see this kind of uptrend. You see a trend line running through here. It gets broken. Your strategy tells you to buy because of condition X. So let's imagine you have a very good bull market strategy here. It tells you to buy the bottom, what you actually wanted to do. But then, unfortunately, you look at the charts a little bit more accurately because, there's a lot going on, fear, sell-off. So, yeah, the strategy might be good, but I'm very careful. So let me do some TA here. Oh, we have a trend line that got broken. No levels here. There are no significant levels here. Maybe here. This would be in a target area or this. But this? So you start questioning your strategy. This is one of the most dangerous things. When you have a strategy and it's working well and it's made to cope with bull market price action, and you start questioning it, you really have. I mean, it's okay to think and reflect and to adapt, and you have to ask yourself: Is the market now a different one? Is my strategy still working? It's a legit question. No questions here. It's okay to ask yourself this, but you have to be careful because your emotions tell you that this is not a good buying zone. Your emotions tell you that this market might come crashing down into this area. So your strategy tells you to buy, and you don't do it. Maybe you even sell it. You counteract your strategy, and this is a moment, in a point in time that you have where you have to hold on, simply reflect, think about: is it wise to act against your strategy at this point? Is it just your emotions? Is it because everyone is bearish, or is it because you really think that your strategy at this point in time stops working? Is the logic behind the strategy not applicable to this market anymore? You have to be very objective here. Get rid of your emotions when answering this question. Rely on facts, rely on TA, but keep in mind that when your strategy that has been successful for a while tells you something that you start doubting, find out if it's if it's based on your emotions or if it's actually based on different market circumstances and your TA. So keep this in mind. Strategies are only as powerful as your ability to act on them. So a rule and condition-based system it's a robot. It's not looking at emotions at all. It tells you, even in an abysmal scenario, you might get a buy signal, especially in abysmal sell-offs. You will get buy signals because most TA tells you to buy there. And your emotions will make it hard to actually act on this. So if you know this, you can reflect, you can start thinking. If we are in such a scenario, start thinking. Don't do anything, just think. And is your strategy still reliable? What are the TA facts that tell you that the strategy might be not working here in this kind of market anymore? So base your logic, base your train of thought on facts and not assumptions and emotions. Very, very important. Then you can actually get the good entries and exits in the markets. Okay. I've just given you an example for static as well as a semi-dynamic strategy. Let's talk about dynamic strategies. And for this, I'm going to use my indicator Cloudy. And I don't know if you have watched my 4-part series on Cloudy yet. It's on YouTube, and the first part explains the difference between static and dynamic support and resistance. This is very important knowledge. So if you haven't watched this yet, I highly suggest you to do this. It will help you understand how to build a dynamic strategy as well. Okay, so this is more advanced now in compared to the static simple strategies. this approach is vastly more complex and difficult to handle, but it has several advantages I want to point out. And but it's not a focus. It's not a focus for this session. I will come back to the easier stuff soon. I just want to show you the difference between the kind of strategies you can come up with. So in this case, I'm going to let me go to the 1 hour chart here, and let me see. Just adjusting the settings a little bit. 10, 15. Okay, so as I told you earlier, when you want to develop a dynamic strategy that is adaptable to all the different market circumstances, you have to use dynamic TA. And Cloudy is an indicator I made that is dynamic, or it's based on dynamic TA, because the clouds you see here, they are constantly on the move. They are changing their structures, appearances, intensities, whatever, based on the market we are currently in. These settings are not good. It's just as meant to show you what I'm talking about. But the logic here would be to use a simple condition and rule-based system based on dynamic TA. So you will end up with a dynamic strategy. It tells you, for example, whenever there's a purple or red resistance cloud, these clouds are supporting resistance, as you might already have noticed. And when there's purple and red resistance, it's a short signal, for example, here or here. And it could also tell you that when there is yellow and teal support, then it is a long signal. Let's see. Okay, the settings are not that good. Let me see if I can get this a little bit clearer. So this would be this is the strategy my bot is currently using as well. Yeah, but I don't have the correct settings right now, but it doesn't matter yet. Doesn't matter now. Okay, so it tells you when there's purple and red resistance, it's a short signal. When there's teal and yellow support, it's a buy signal. So you can see how the system is changing based on the markets. And you can see that the signals are actually not bad in this case, but they could be better, of course, with the settings. However, the special characteristics of these clouds are that they, in bull markets, bear markets, in times of high and low volatility, and so on, they change their appearance, their trajectories, and everything. So they are actually adapting to the markets by themselves. And by using dynamic support and resistance, you can come up with strategies that are also dynamic, because the rules and logics, the conditions are bound to this dynamic system. So they are also dynamic. This is very, very interesting to follow. Of course, it's advanced stuff, and I can't explain how to develop this kind of dynamic TA in a quick session. But yeah, the more this channel will grow, the more content I will provide to give you the capabilities to actually come up with this kind of stuff yourself. So I hope you get the idea. I don't want to dive too deep into this right now, but this is an approach how to grab or how to catch the different moves in the market. Of course, you need a very, very strict set of rules and conditions to make this work. It's not easy to do this. You have to know exactly what you're doing. For example, when here you can see, in this case, you have sideways, clouds going sideways, you can easily sell the resistance, you can buy the support, it works out for a while, then the market is changing, it's starting to trend higher, and you can see how now the where you want to enter shorts here, this zone is being penetrated by price action. So your strategy has to have certain conditions and rules to identify price action or changes in price action and trend. So then it makes sense to follow this kind of strategy by shorting resistance. For example, let me just explain this in a very simple way. As you can see, we have red and purple clouds over here, which would be a shorting signal. And maybe the system actually enters a short here, which would make sense. But it also discovers that you see how this this trend is very, it's up and it's gaining traction. Maybe the volume is increasing. And this candle here pierced right through the resistance zone. This is a warning signal. And when you have logic implemented into your strategy that identifies these situations, you can prevent yourself from getting wrecked on these moves because it's shorting again and again. The system is shorting, or you are shorting this again and again because your strategy tells you to. You have to restrict your strategy from sending you signals all the time. So my strategy in this case is rather simple. The bands are still resistance. They are still valid, but the trend is too strong to short into this. So all kinds of sell signals are suppressed at this stage. And the strategy is waiting for the momentum to run out, the upside momentum to run out. Then, as you can see, the resistance clouds are at some point, they come back down. And then you see that price can reject at these clouds more easily than it did before. It literally crushed through this here, but here it scratched the clouds, retraced a little bit. You could have taken profits on a move here with rejection. So it works actually better. The strategy is highly adaptable, and this is something that is, of course, much better and much easier to implement for trading bots, for example, because as a trading bot operates simple on the logic it has, on the conditions and rules it got. So you as a person, you can still think, and when you see the trend is too strong, I skip this entry. Of course, it's dangerous, as I told you earlier. Whenever you start questioning your own strategy, you have to really think about why are you doing this. When it makes sense, because this trend is parabolic and too strong, so you don't want to short into this, it's perfectly fine. You can, as a person, as a human, you can still make adjustments on the fly. A trading bot can't do this. It's simply acting based on logic that it got from you. So in this case, it is important to implement these kind of workarounds and adjustments and additional conditions into a strategy to make it even more dynamic, more adaptable. And this is this shows that you can go to extreme lengths to come up with very, very profitable and very successful strategies that work in all kinds of markets. You have to put in more knowledge, you have to put in more effort, you have to put in more time, you have to test more, you have to find the TA that works first. Difficulty level is very high. And it can take up years. It can take years until you find something that works really well. However, once you found something like this, yeah, you can keep it. You don't have to do anything anymore. It's just working, and yeah, you can let your trading bot trade in all eternity and make profits for you. It's a money printing machine, and this works. This is I'm doing exactly this right at this moment. So, but for beginners, of course, I would not recommend to try this because you need more experience and TA knowledge to approach this. What I would recommend in this case is try out different static strategies that work, and try to identify the points in time when a market is changing, when the market circumstances change, and try to adapt your strategy so that it will keep its reliability. This is the main challenge. If you can do this, you can come up with really, really great strategies, and you will you have the potential to be very profitable with them. But it's not easy to do. So a final part of this session, I want to talk about different indicators you can use to combine to come up with reliable strategies. This is very helpful. I know that a lot of courses and content on the web doesn't really tell you much about how to build strategies. So I'm now going to do this. And I already told you about the moving averages and exponential moving averages. And let's have a look at some other indicators you can use. Let's take the RSI first, the relative strength index. If you don't know what that is, look it up on Investopedia or somewhere else. Very important indicator you really have to know as a trader. And I'm going to make this a little bit more visible. Okay, this is the RSI. Now what I'm going to take as well is, let's say, the moving average. I'm taking the 50. Yeah, this is the 50-hour moving average. Okay, let's start like this. I want my strategy to sell bearish divergences whenever price is above the 50-hour moving average. This is my goal. So I think that when we are above the 50, as you can see, price is moving around the 50-hour moving average here. It's always coming back to it. It's because it's a moving average. And my idea, so you start off with an idea. When you want to build a strategy, you start off with an idea. My idea is that when price is above a moving average, like this, and it always comes back to it, it can be considered high. The price can be considered high in relative terms in this trading range right now. So when the price is high and we see a bearish divergence that indicates weakness in the market, then I expect a retracement or pullback to the 50-hour moving average, or maybe even below that point soon. This is my assumption. This is my thesis. So when you want to define or develop a strategy, you start off with a thesis based on your logic, your own logic, your knowledge, your observations, whatever. You take something that you think is true and you want to test. Now you got two indicators that can tell you if your assumption is correct or if it has been correct for a while at least. So in this sideways market here, you can see we have this. We have some price action above the 50 hour here, 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 here. So this is these are the four zones where our strategy would have told us look for bearish divergence. Now we try to identify bearish divergence. If you don't know how to do this, look it up. Very important knowledge, basic knowledge for beginners. And it tells you a lot about the market. So this is a skill you have to get as soon as possible. Identify divergences based on RSI at minimum. So here you can see I'm on the 1 hour chart. I draw a trend line from this high to this high. You see we have made a higher high on price. And now I look on the RSI and you can see from this point on to this, we have made a lower high on the RSI. So we have confirmed bearish divergence. We have confirmed bearish divergence from this point on. And we are above the 50-hour moving average. So our strategy would tell us to sell. This would be a sell signal. As you can see, we had a nice downtrend here. We could have taken profits at the 50-hour already, taken some profits out, because this is our main target. And as you can see, there is some kind of bounce taking place. Could have stopped us out here. Could have been very close. But I would take 100% out here, of course. We expected to move to the other side, and this is what happened. So you could have had profit targets down here. Let's look at this example. We have a higher high on price, and we have a higher high on RSI. So this is no bearish divergence. So we don't have a sell signal here. Then we look at this case. So here you can see we have higher high on price. This is a very tiny one, tiny top. But as you can see, we have a lower high on RSI. So this is bearish divergence as well. And as you can see, it would have been a sell signal. We are above the 50-hour. Price went down, so this would be a hit for us. Be a nice entry. Then we have this kind of price action here. You can see higher high, lower high on RSI, bearish divergence confirmed. We have some sideways price action here. This kind of price action, as you can see, it's grinding sideways until the 50-hour moving average has caught up with price. This is something that usually leads to continuation higher, but in this case it didn't. And we saw a downtrend. We could have had our stop loss here, it would have stopped out. But depending on how you handle your stop losses, it could have worked out to catch this downtrend. So as you can see, this kind of strategy makes sense. It gives us a correlation with bearish price action. So our idea is not wrong, but we have to see how we can optimize this. And we also have to see if we start trending up here, will it still be valid? So we have to notice when the market changes, and the circumstances change. And then we have to see if this thesis remains true in this kind of market. This is what I talked about earlier all the time. So maybe you will have to take a different moving average, or you will have to watch for bearish divergence on a much higher time frame. You can change your strategy like this, and yeah, make sure it remains profitable. Okay, let's look at something different. Maybe just one thing I want to mention is the more indicators and requirements you include in your strategy, the less signals, the fewer signals you get. So more requirements means fewer signals, of course, because more things have to coincide, have to match with each other to actually produce a signal. So you get fewer signals, but when you're doing it right, you have a higher reliability of these signals. So what you want to do is to find get to a trade-off between the amount of signals and the reliability of these signals. You can come up with strategies that give you one signal per month, but it has a strike rate of 95%. If you got something like this, why not? I mean, you can use it if the risk reward is good and it's actually worth looking at this strategy. You can use this, for example, for swing trading or investing or something like this. So more like swing trading. It's more. This could be a good swing trading strategy. I mean, one signal can be sufficient. If it's a really powerful signal and you make a lot of money on these moves, you can risk more because it's more reliable. However, don't risk too much. Keep your risk management in place always, especially when dealing with strategies. But then you can make use of the strategy, of course. But if you want to day trade and you want to make money every day, of course, one signal is not enough. So you have to find a strategy that produces daily signals with a decent strike rate. Decent strike rate in terms of gains, right? Not just it's a trade that worked out, but it has to be profitable to you for you, because you can have 8 wins and 3 losses and still lose money when the losses are higher than when they are higher than the profits you gain from the wins. So you have to be very careful about that and always monitor how your strategy is performing. You can use the backtesting tool, and if you don't know how to code in Pine, I would recommend to learn this. It's even if you're not a coder, it shouldn't be too difficult to learn this. And you can easily test your strategies this way. Let me show you a quick example on the Pine editor. I'm going to open a new blank strategy, and here you can see that this in itself is a strategy already with 7 lines of code. You have a headline. It tells you the name of your strategy with some parameters. And then you have the conditions that the system is looking for. In this case, you can see we have a long condition. Let's stick to long and get rid of short. So we have a long condition, and it's looking for crossover of the simple moving average 14 and a simple moving average SMA 20 on the current chart. 28 on the current chart. It's looking for this kind of crossover. So the smaller one crosses over the larger one. And if this condition is met, if long condition, then the strategy will produce an entry for your long. So this is basically all you need to come up in terms of code. You need to come up with an automated strategy that you can backtest on TradingView. It's very simple. So this is not hard to learn. You don't have to be a programmer or developer to understand this kind of script, and you can write this easily yourself. You have lots of different documentations here on TradingView that tell you how to set this up. Fairly easy. Now, look, if you want to simply you want to test this strategy right here that the system gives you by default. You add this to your chart. It's called My Strategy. Here you can see My Strategy. It's a long, so we only have longs in it. I'm going to go to the, oops. Okay, no data. This is strange. Let me see. Crossover, long condition, SMA 14 and 28 on the 1 hour. So this is actually correct. Why isn't it working? Strange. Maybe I have to save it. I don't get it. Okay, let me quickly make a new one. New blank strategy. Give this a name. Save it. Add it to the chart. Now it's working. I don't know why the other one didn't work. Okay, so here you can see it shows you where it would enter the market and where it would exit the market, or would enter shorts. In this case, it would be longing and shorting. And you can see how it plays out on the chart directly. And when you go to the strategy tester, it will tell you how your performance would look like with this strategy based on the time you're looking at here. So it's actually looking at this entire market. As you can see, this is the market, looks like the market of Bitcoin. So this is how you can easily come up with your own strategies and test them with this backtesting tool. It's not difficult. Get into it if you really want to become a trader who is, if you want to take your strategy seriously, I would recommend to learn this. It's a skill that is very important, that you know how to test your strategies properly. Here you can see net profit is it's minus 2.5%, so it's not a profitable strategy based on this entire time. This is, you get some KPIs here you can look at. So if now I can change the strategy, for example, I can say I want to want to look at the SMA cross 1428. I want to see the EMA cross 50 200. Just changing the SMA to EMA. Very simple. 50 200 cross under. For short, the condition is to cross under, not cross over. So it waits for the EMA 50 to cross under, to cross below the 200. So this would be some kind of death cross type we're looking at here on the 1 hour. Let me save this. Okay, it's missing a bracket. And there you go. Now you have your adjusted strategy, and you can see it's actually profitable, 6.5%. So this would be a 1 hour golden and death cross based trading strategy on the EMAs. Here you can see the entries. You can customize your strategies very well. You can add profit targets and stuff, but for this you need, of course, you need more coding knowledge in Pinescript. As you can see, it's a very useful tool, but it doesn't tell you anything about future price action. This is very important to understand. This is past price action, and future price action might play out differently. As I explained earlier, markets change, so keep this in mind. Yeah, one thing, one word about death crosses and gold cross, because it's a topic that is currently being discussed heavily again. It always comes up every few years when there are more newcomers in the market. Things like death crosses and golden crosses become interesting again. You really have to know what you are looking at. When you're looking at an EMA cross, let me put this on the charts. This is maybe important or interesting to you if you are thinking of making EMA or SMA cross strategies. So let's take the 50-day, what is it, EMA? 50-day EMA, and take the 200-day SMA. So here you can see this is what a lot of people are looking at right now. Always think about what do these lines tell you? The shorter EMA, the orange one, tells you about the short-term trend. The short-term trend, because it's a shorter term. It's, of course, when you see downside price action, it's going down slowly. So it tells you we are in a downtrend. Now, what does the 200 EMA tell you? We are in a long-term, in this case, more like midterm. We're in a midterm uptrend here. You can see we're in a midterm uptrend. It's going up. Now it's going sideways, which means we're not in a midterm uptrend, but midterm sideways market now, short-term downtrend. So at some point they cross. The 50-day EMA crosses under the 200-day EMA. And this is what is called a death cross and what people are freaking out for. But there's no reason, because it tells you that we have been in a downtrend for quite some time here. We have been in a downtrend all this time already. And this is the logical consequence, the logical result of a shifted market. We have shifted from a highly bullish trend now to a bearish trend, or more like right now it's more sideways, but it's still, this is up, this is down. So we have shifted, and the EMAs only tell you that we have shifted. It doesn't mean we will crash from here. It simply tells you that we have seen downside price action. Yes, it could mean this trend will continue down. This is possible, but it is not what the EMAs tell you. This is not what you can read of this death cross. What you can read is this price action, this, and not this. So there's no reason to freak out about a death cross. It's completely fine, because it only tells you, yes, we are in a downtrend, but it doesn't tell you we will still be in a downtrend tomorrow. There is a correlation, of course, when we have been in an uptrend and we turn it into a downtrend and death cross occurs, it correlates with further downside price action. This makes sense, because the trend has changed. But you don't know if this trend will continue down, or if we will recover, maybe after going sideways, and we'll recover like this. I mean, a lot of bull markets had this kind of price action, so you don't really know. When you make a strategy out of this, be aware of this, that it's not reliable. This is not reliable. Death crosses and golden crosses are indications that don't tell you about the future, they tell you about the past. And when you use this for your strategies, expect your trades to fail. It could happen. The reliability is not nearly as high as with other good strategies. So EMA crosses, sure, you can use them as additional confirmation, but I would always recommend to use something different as well. For example, you can take RSI, divergence, Bollinger Bands. You can combine all sorts of stuff. You can take whatever you like. You can use your favorite tool like GANFAN, or you can use MACD crosses and whatever. You can come up with a compilation with a composition of different indicators and signals that you can put together to build your own strategy. Don't only rely on EMA or SMA crosses. This is not, I would not recommend to do this. So take things that actually describe the market and not the past. Okay, this is it for now. I want to go more into this topic of strategies later when there's more content available on TA on my channel. I think it's more important to produce the content around TA first, and then put this all together in actual trading course-like sessions, like this, for example. But this should help you in order to find your way into the world of strategies, to come up with your own strategies, to use some indicators, what to look for. Yeah, as I said, starting off with static strategies and making them semi-dynamic, step by step is a good way to approach this. You don't need dynamic strategies to be profitable. But once you're very advanced, you have a broad portfolio of TA knowledge, then you can think about making dynamic strategies simply because it's easier to maintain them in the future. You don't have to change all the things again and again. Yeah, and they are very well suited to be applied with trading bots as well. Okay. Hope this was helpful. Give me feedback. I would like to hear your thoughts on this. Yeah, see you next time.